Most people are stuck on this idea that you need $1 million to retire on dividends. They imagine waiting around for months just to get a check that, barely covers a utility bill? Well, let's just tear that idea up, because in 2026, the entire game has changed.
You can actually start getting paid every single Friday. And the best part, you can start with as little as $100. So today, we're going to build the foundation of this strategy. I'm going to show you the low stress way to get that weekly paycheck using government backed ETFs that, frankly, most investors are just completely sleeping on.
I've been digging into the 2026 market for months, and believe me, the landscape is nothing like it was even just a couple of years ago. Monthly dividends, that was the old gold standard. Now, we've got the tools to build a literal weekly cash flow machine. And this right here is part one of our three-part series where we're going to do exactly that.
But hang on, before you even think about putting a single dollar into any of this, you absolutely have to hear this warning. Seriously, don't skip this part.
So, you've probably seen older videos talking about weekly ETFs like TGIF or WKLY. Well, take a look at what happens when you search for them today. They're gone, closed, liquidated, vanished. And this is exactly my point. If you're following old advice, you're literally chasing ghosts. This income game moves way too fast for that.
So here's our game plan. By the time we're done with this series, you're going to have a complete three-tier portfolio. Today, it's all about building that foundation with the safe, sleep well at night ETFs. Then in part two, we'll get into the big tech weekly payers. And finally, in part three, we'll turn up the heat with some high-octane yields for those who are feeling a bit more adventurous.
Okay, so you might be asking, why are we so obsessed with weekly payments over the good old monthly ones? Is this just some kind of gimmick? No, absolutely not. There are a couple of huge, rock-solid reasons why this is just a smarter strategy. First off, it helps solve what is probably the single biggest nightmare for retirees: sequence of return risk. Just think about it for a second. If the market tanks and you need cash to pay your bills, you're forced to sell your shares at the worst possible time. But when you get a fresh paycheck every Friday, you don't have to do that. You're no longer a victim of market volatility. And this quote right here, this really nails the mindset shift we're talking about. You stop liquidating your assets. Instead, you're just living off the rent that your capital is paying you. You never have to touch that core principle when the market is down. And the second reason? It's just pure math. It's all about compounding speed. When you reinvest your cash every 7 days instead of every 30, your money gets back to work that much faster. Now, it might seem like a small edge, but over a decade, that frequency alone can add thousands of dollars to your account. Okay, so where do we begin? Well, we have to start with safety. This first tier, Tier 1, is all about protecting your hard-earned money with funds that are backed by the full faith and credit of the U.S. government. So our first foundational ETF is a real workhorse. It's the Round Hill Weekly Treasury Bill ETF, and the ticker is super simple, just WK. Right now, this is pretty much the gold standard for this strategy. It holds U.S. Treasury bills, it pays you every Friday like clockwork, and it has a tiny expense ratio of just 0.19%. I mean, this is about as safe as an investment can possibly get. And to put some real numbers on it, if you put $50,000 into WK, you'd be looking at about $35 to $40 coming into your account every single Friday. Hey, that's a utility bill or a tank of gas, paid for with almost zero risk. All right, next up, we've got the ticker MMKT. This is the Texas Capital Government Money Market ETF, and honestly, I think of this one as your emergency fund on steroids. Now, the key feature to notice here is that it holds 99.5% in cash and U.S. government securities. What that means is, if the S&P 500 has a horrible week and drops 10%, MMKT, it won't even flinch. It's just incredible stability that also happens to pay you every Friday. Our third foundational piece is a bit of a newcomer. It just launched back in January of 2026. It's the Rex Ladder T-Bill ETF, and the ticker for that is TLDDR.
So this one holds super short-term T-bills, but its real secret weapon is active management. This lets the fund managers pivot and adjust things really quickly when the Fed starts changing interest rates, and that is a massive advantage. Splitting some of your cash between WK and TLDR is a really smart play. Okay, so we've built that solid, safe floor for our portfolio. Now, let's just dip our toes into a slightly more advanced option and, more importantly, a crucial tax consideration that you just cannot ignore. The last piece I'll mention for our foundation is TSYW, the Round Hill Treasury Bond Weekly Pay ETF. Now, I need to be crystal clear about this. This one is different. It carries more risk. This ETF uses a bit of leverage, 1.2 times, and it targets long-term government bonds. And as you can see, the yield is a little lower and the expense ratio is much higher. Because long-term bonds get bounced around by interest rate changes, you should really only think of this as a small satellite holding. It is not your core. Use WK and MMKT for the floor. Okay, let's talk taxes, because this is critical. The income you get from these ETFs is fantastic, but it's not a qualified dividend. Because it's basically interest from government debt, it's considered ordinary income. That just means it's taxed at your regular income tax bracket, not the lower capital gains rate. But here is the awesome part, the powerful tax hack that makes this so smart for so many people. If you live in a high-tax state like California or New York, the income from these U.S. Treasury ETFs is generally exempt from state and local taxes. This can significantly boost your real after-tax yield, making it way better than a savings account or a corporate bond fund. So there you have it. These ETFs, WK, MMKT, TLDR, and maybe a little slice of TSYW, they are your floor. They give you safety, they give you liquidity, and they give you a consistent cash flow you can actually rely on. But I know why you're really here. You want the bigger checks, right? Well, that's what part 2 is all about. We're going to leave the safety of government debt behind and dive straight into big tech income. I'm going to show you how to get paid weekly by the S&P 500 and the NASDAQ 100 with ETFs like QTDE and XTDE. And how we can literally force the Magnificent Seven to pay you a weekly dividend that makes that 4% yield look like pocket change. I'll see you in part 2.